Hello everyone, this is Paul from the PN Academy, and in today's video, we're going to be looking at the things you should be checking out for before you can take any trade, no matter what you're trading, whether you're trading cryptos, whether you're trading forex, whether you're trading stocks. But of course, most of us are trading forex and indices, or the normal indices, the stock indices, and also synthetic indices. So these are the things you're supposed to be checking out before you take any of those trades that you're planning to take out. Whatever is on your watch list, before you even think about pressing the buy button or sell button, these are the things you must be looking out for. I've categorized them into three, but before we look at them, if it's your first time coming across this channel, make sure you click the subscribe button. And also, if you feel it's the video you've been looking out for, make sure you give us that thumbs up button. So I have categorized them into three. The first one is market structure. Now, market structure is divided into two. Market structure, one, has to give you the direction, right? Then two, market structure has to give you the foundation, the basis on which you're going to take the trade. It has to give you what is going to determine, are you going to buy or are you going to sell, right? One, let me just repeat that. Market structure has to give you the direction. Then two, market structure has to give you the foundation, either you buying or selling, meaning it's giving you the structure whether to determine by yourself whether you're going to click buy or you're going to click sell. Then the second one is the area of interest. Of course, market structure, like we have said, gives you the direction and then the foundation, what you're going to trade. By foundation, I mean, is it giving you a W? Is it giving you an M? Is it giving you a trending market, etc., right? So these are the things that do give us the area of interest. Now, what do I mean by area of interest? Area of interest is whereby you say that in this area is where I'm looking for the possibility of taking a trade. When the price reaches this area is where I'm going to think about putting this on my watch list so that I can wait for an entry. So when the market gets to your area of interest, that's when you start thinking about entry. Before it gets there, you don't think about entry. But also before entry, we need to look out for change of trend. Now, all these things, you cannot start thinking about them before the market creates for your area of interest, right? And how do you get to area of interest? You have to first have the structure of the market, right? We're going to look at all these things in detail, right? So, and then the last one is you have to plan for targets and invalidations. By invalidations, I mean that if the trade has failed, or if the trade you feel is not going to continue that direction and you feel that it's going to be premature. So you have to maybe put your stop loss into profits or at break even so that you do not lose any money or you do not lose the trade that was already running in profits in your favor, right? So once again, we have three: market structure, area of interest, stroke entry, and also you have to plan your targets and invalidation limits, right? So now let's look at these things in detail. Are we together? Let's look at these things in detail. Let's start with the first one, which is market structure. Now, we have said in market structure, you have to first get direction, right? And then also after getting direction, whether you're going up or you're going down, then after that, you have to determine, is the market ranging or is the market trending? Now, we have two types of trending, whether trending downwards or we're trending upwards. So this is what market structure gives you, right? So when you're going to take a trade, or when you're planning to put a certain pair or a certain index or whatever security you're trading onto your watch list, you have to first get a direction. You cannot just get out of your home and say that I am going to ABCD without a reason. You need to have a reason. And that reason must be at least strong enough to make you leave your place, right? Maybe, for example, you have a job. You know that by 8 a.m. or by 9 a.m. or by 10 a.m., I have to be at the office, right? So that is a reason. That's the direction you're taking, that I have to go to my office because I have to be there to do ABCD, right? Then after that, you get the structure for yourself. How are you getting to your office? What means are you using to get there? Are you using a plane? Are you using road transport? Are you using a train? Are you using water transport, etc.? This is what we mean by structure, right? Now, structure is in many forms. We have talked about, is it ranging or is it, for example, if it's ranging, it's creating equal highs and equal lows, right? And then also we can have a situation where the market is trending upwards, making higher highs and higher lows, right? Then also we have a situation whereby the market can be making lower lows and lower highs. Now you can clearly see I've tried to illustrate for you guys here. I've gotten for you chart examples that show you exactly how it happens on the chart. Now, most times when we're illustrating for you in theory, we just draw something like this. We draw these waves. But on the markets, it's not going to be as smooth as this. That's why I've decided to bring for you pictorials from the charts, right? So also a structure can be shapes like an M or it can be a W, or it can be an impulse, right? We have all these topics in detail on our channel, and I'm also going to attach them in the card just in the top right corner. So if you do not understand them in detail, the videos will be in the top right corner. Just check that card in the top right corner. So these are some of the examples of market structure that you can trade. The market can be trending downwards, or it can have a structure. Now, these structures, these shapes, sorry, not structure, but these shapes like M's, W's, head and shoulders, inverse head and shoulders are gotten when the market is trending. These are the three major types of market structure. The markets are trending downwards or trending upwards, or it can be ranging. Now, in a range or in a trending market is when we get structures like we get shapes and patterns like M's, we get W's, we get head and shoulders, or even impulsive markets. Let's take an example from here. In this ranging market here, the price gave you a W, all right? And you know the rules of a W, the market has to come back and retest the neckline and then pushes back up. The same things keep happening there. Also in this same ranging market, you have an impulse whereby we expect the market comes to make a retracement and then finishes the impulsive move. So also the same things can happen here. We can have M's and W's. For example, here we had the W, the market broke the neckline, retested it, and then we pushed up, right? Also here when the market was trending down, the market, we had an M here, the market retested the neckline, then it continued down. So the shapes and the patterns happen in one of these three types of markets, either trending upwards, trending downwards, or in a ranging market. I hope that makes sense to you. In case I'm very fast for you, you can just slow down the video so that it makes sense to you. Then also, this is just theory. We usually start with theory if it's your first time, and then we get to backtest an example on the charts, whereby we put all these things into practice on the charts and we see how the trade plays out until when we take an entry, right? So just stick up to the end so that you can see how we implement all these things that we're speaking about. So this is part of the market structure that you need to understand. After getting there, you need to understand area of interest. How do you get area of interest? I'll give you an example. When you are walking on the street and you look at maybe a group of ladies and there's a particular that you like, there's a reason for why you've liked that particular lady out of that whole group. So that reason is what is going to give you the interest, maybe to go for that lady or to approach her, to say hi or get her number, etc., etc., right? So now, how to mark area of interest? Remember, we have said that structure you're getting it from a trending market or a ranging market, right? And after that, when you identify that you're in a trending market or ranging market, you need to get shapes or patterns that are going to give you a foundation to either buy or sell. Are we together? Now, having gotten that, you need to determine, am I trading a continuation or a retracement? For example, if the market is trending upwards, you will have to determine, am I trading this pullback here, this retracement here, or I wait for the market to come back into this area here, then I go up with it. The same applies if the market is going down, up, down, breaks here. You will determine that, am I trading this push up, or I'm waiting for it to get into this area here, and then I can push down with it, right? You need to be very, very articulate with this. You need to be very specific, right? Do not cause confusion to yourself. Most of you are finding, confusing yourself, and you're like, should I trade this or should I trade this? And then you end up missing on the trade, or you end up taking premature entries because you did not plan for that trade. Are we together? So now the continuations and retracements, how do they actually look like? For example, I've just illustrated this. If the market is, let's say, moving down, high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. Now you're here. You have to determine and decide, am I trading this push to this previous low here? Because we know when the market makes a lower high and breaks down, we expect the market to retrace here. Unless this is an impulsive move, that's when it will not reach here and to stop at the fib level, then it pushes down, right? So, but this is not a very strong impulsive move. So the higher chances the market could come back here. So you have to decide, am I trading this push back up or this push down, right? So, and then I further illustrated to you how you can actually mark that. And how can you mark that is just like this, right? You will just mark this previous lower low here. So you can either trade this, I've showed you this arrow here, or this push down. Don't worry, we're going to do all this on the chart. Then this will be your invalidation areas, this lower high here. In case the market breaks above and pushes up, it means it has created even a bigger W, stating that it's changing trend, that it will retrace here and possibly start pushing up. Are we together? So this is how you determine your area of interest. Now, area of interest is down whereby you're going to look for a change of trend to give you the area of entry. Without this area of interest here, you cannot even think about entry, because you need to first get, for example, if you want to buy from here, this is your area of interest. If you're waiting for a trade to come here, this is your area of interest. So the trade or the price must first be in your area of interest. For example, if it is here, then I can go to my area to my entry time frame. Let's say if it is H4 or H1, then I start looking for my entry reasons for change of trend, right? So this is how you use the area of interest, stroke area of entry. We're going to do for area of entry on the chart practically so that you can be able to understand it. Here it's most of the explanations about area of interest, whereby you have to first get reasons that will force you to go into that trade. Not force you actually, but that will get you to be interested into the trade. Are we together? So having gotten the interest into the trade, what are you looking out for next? The next thing you're going to look out for is planning for your targets and invalidation areas. Now, most of us tend to just plan for the stop loss. Why do you want to plan for stop loss without also planning the targets? You have to plan the targets. By targets, we do talk about the take profit or the positive exit. Sometimes your trade may not hit the take profit, but also it may hit your positive positive trading, or also sometimes you may just decide to close manually. Maybe if you notice there's some events coming up that you aren't aware of before you took the trade, and maybe your trade is 80% or in your direction, you can decide to go out of it. That's a positive exit, right? Then also the second one is the take profit, where sometimes the trade runs directly to your take profit, right? Then also there are some emergency exits, like I've explained. You may realize later on in the trade that actually there's news coming up and you didn't plan for it. Or maybe you believe you're going to get occupied, then you decide to trail your trade, a positive trading, right? There are those emergency exit targets that are positive in our favor, that you will not lose money, but rather you will go out with still some profits. Then the one that most of us focus on is the invalidation, which is the stop loss. And also we do not know how we set stop loss. And also we sometimes we tend to set them very tight, and it hits us out and then continues in our direction. So you need to learn how to set these things properly. I'm going to just show you an example here on how you can actually plan all these things. So let's start with this trade. Let's assume that I have this lower low, lower high, lower low, and I want to take this trade back to this level here. So I've gotten my area of interest, which is this one here. I've gotten also my direction and the structure. What is my direction? I'm down here. I need to take the trade up. So the direction is that I'm going to trade upwards. I'm looking for a buy, right? Then the second thing that I have to look for is the structure. What's the structure I'm trading? I'm trading lower lows, lower highs, lower lows, lower highs, lower lows. So we have broken this low. I expect to go up. And also, if you can clearly see, this is another type of an M like this, or you can simply take it as a lower low, lower high, lower low, lower high, lower low. Are we together? So we have gotten the direction, which is up, a buy. And also we have gotten the structure we're trading, which is here. So where is your target? You have to get your target. Also, your target is this one here, this area here. So you will put your target just slightly below this area here. And then how do you get your stop loss area? Your stop loss area is gotten into the time in which you're going to take your entry from. Are we together? So let's take an example that you're planning to take this trade upwards. So this is your target area here, just slightly below this blue slab. Now we're going to get into our entry time frame. Now this will be your entry time frame, and you will take your trade, let's say, after spotting your rules of entry. For example, double bottoms, breaking of a lower high. For example, we're pushing, this is a sell. So if the market was going down, you need a lower high to be broken so that you can take your trade. And always take your stop loss should be below the structure, always, right? This is a very small image, but we're going to look at it on the chart. So we had the structure here, and that's why you see our stop loss is below here. This red color here means the stop loss area. And also this green one means the take profit area. That's why you see we put our take profit just slightly below this blue slab, like I mentioned. Do not put your target exactly here. And our risk to reward ratio was 1 to 3, meaning we're risking 1% of the account to gain 3% of the account. Now, you can clearly see that we wanted the market to push up, which it did, right? So now we are waiting for the market to give us rules so that we can also take the trade downwards. Now, why do I have this green on here but no stop loss? Because the trade has not yet confirmed. So I'm just putting, if it can take out this confluence that we have this counter trend line here. We have this touch, second touch, third touch. So the market is still playing here. It's still in this lower high area here. All right, together. As long as the trade does not take out this area here, which is around up here, as long as they take it out, we shall still be looking for sales. Now, when the trade does not confirm from this area, do not panic. Sometimes the market may stretch and come into this area here, right? Then you can look for a better risk to reward ratio entries actually. But what most traders tend to do is when the trade exceeds the area they had marked, they tend to give up and say, no, this trade is now not good for me. Yet actually the trade is still in a bearish zone whereby they can look for more trades and actually utilize it and make more rewards, right? So the more the trade stretches, it's better in your advantage. So these are the things that you need to look out for before taking a trade. One, you need to get the structure, and then two, you need to get an entry area or area of interest whereby you're going to be interested in taking the trade. Then after that, you plan your entry and then your exits, right? Then after that, you'll be able to really have a clear plan, right? Most people just talk about plan the trade, but you don't know how to plan it. Now, if you follow this, this is going to really help you to get always your trades correct, right? You may not always make profit, but at least you will have a clear plan that you're going to be following, or you will have a clear checklist that will help you to execute trades properly, right? So now all this has been theory. I've been trying to illustrate to you so that you can understand it. Now let's try to get onto the chart so that we can do it practically with one example, right? Okay, so I'm going to use CAD CHF because it's what we have been looking at mostly on our examples when we're doing the theory. So we have a market that is doing lower low, lower highs, lower lows, lower highs, lower lows. So what we're going to do is first we've gotten our direction. We're now down here, right? What is giving us this direction is this. Let me just start to clear this so that we can have a clear chart. So what's giving us this direction here is we have hit a support level here, right? So after hitting support, what do we expect? One, we have a market that is already pushing down, and also we have hit a support and we have broken this level here. So meaning there are higher chances we could push up. So meaning we are looking for buys, right? So having gotten the direction that we're looking for buys, and also we have gotten the structure that we are trading. Now what next? I want us to mark our targets. After that is you are supposed to mark your target. Now I'm going to mark my target just here. This is the area that I want the price to get back to because it's making lower lows, lower highs, lower lows, right? This is what the market is doing. It's making lower low, lower high, lower low, lower high, lower low. So now we need it to come back and retest this area here, right? So we have gotten our market structure, we have gotten the direction, and we have gotten what we are trading, and this is our target, right? So after doing that, now we need to go to our entry time frame. I'm in weekly. So remember how to do multi-time frame analysis. You get your structure in weekly, right? And then also you get your structure in, let's say, weekly if you're swinging. Then you get your entry in H4, and also you can refine your entry in H1, right? We spoke about this in our previous videos when you're doing a multi-time frame analysis. I'll just attach it in the cards above in the top right corner. Now, so since we've gotten this, if you want, you can just check in the daily and see if you have any threats, right? Now, when you come down to daily, we do have a slight threat here, which is this neckline area here. But as long as the market goes above this area, then you can actually take your trade up to up here. So we know that this is the only threat. Now let's go to H4, and then we can now plan. We have already gotten our target in big time frame. Now the only thing we're left with is to get our entry and our stop loss area. And where do we do that from? I told you that we do that from our entry time frame. So now we know that the only threat we have is this red area here, or just slightly below this top area here, right? So what are you going to look out for? You're going to look for the market to create for a structure, and then you can take the trade and then identify your stop loss area. So let's wait and see if the market can give us a structure. So the market breaks this area here. So it's approaching this point here, right? So already you have a W. Where's the W? The W is this one here, right? Let me just change the color to red. This is the W here that the market has created, right? So if the market can take out this area, it can give us a push back down here, we shall take our trade. Either it breaking here or making a small pullback and rejecting, then we shall be able to take our entry, and then our stop loss will just be below this structure here, right? So already we have our target, which will be slightly below here, and it should give us a 1 to 3. The moment it give us a 1 to 3, we have to adjust either the stop loss, make it a little bit tighter, which is sometimes risky, but we need to get a 1 to 3. Always make sure you're getting a 1 to 3, or at worst 1 to 2, right? So let's see how the trade plays out, right? So here the trade broke this area of ours. Now, if you want, you can actually go to H1 and then you refine it. Remember, we've said if you're using H4, you can use H1. So if you're to go to H1 to refine, then this would be your entry here when it was closing above here. So this would be your entry, and then your stop loss will just be below this area here, right? To just be below this area, and then your target will just be below this point here, right? So let's see how the market will play out. The moment it comes back to give us a retracement, then you'll be able to take more trades. Let's see how it plays out, right? So let's see how it plays out. We had a little bit of the market going to profit and then came back down, right? So let's see if we shall hit take profit or we shall hit stop loss. Always make sure you plan your trades that time when you're taking it. You plan for the stop loss, plan for the target and all that. Do not plan after. That is the bad habit. It will make you have emotions when you're trading, right? So let's see how it plays out, right? So you just let it play out. If it hits your stop loss or your target, it's okay, right? See what it does. Okay, it's a bit taking long. Of course, it's a swing trade, so it's okay. Let's see if it will hit our target. It's a swing trade, so it took a little bit of time because we got our setup from weekly. Okay, it's still playing, but we need our target to be hit a 1 to 3, of course. Worst, always your risk to reward ratio should be a 1 to 2. Do not go below 1 to 2. Always go for worst case of 1 to 2, right? So, but I prefer using always 1 to 3 so that even if out of 10 trades I lose, let's say I lose 5 trades and I only win 4, I'll still be a profitable. Meaning I've lost 5% and I've won only 4 trades, meaning 4 times 3, that's 12. 12 minus 5%, that is 7% still in profit, right? 12 minus 5 is 7, right? So this trade hit our take profit, this one here. So if you're trading the push up, you would have already hit your target, right? So if you go back to the weekly time from where we got our structure from, you'll be able to observe that the market came back and gave you that retest there, right? Now, there's one thing I would like to make clear to you guys, and which is killing most of you people, is most of you would like to trade in between here. It is very risky. Do not trade in between here. Always trade at major levels, either this level here or this level. Now, I normally use weekly because I'm a swinger, but also you can be able to identify your structures in daily, right? Daily is used by people who use H1 and people who do intraday or want to hold some trades for a few hours, right? Also for scalpers, the concepts are the same, just what switches or changes is the different time frames. And we have tried to make how you can scalp videos, how you can do intraday on also this channel. So just make sure you go through our videos, the videos on our channel. You'll be able to find those videos so that you can be able to utilize them. So that was it for this video on the checklist that you must go through before you can take a trade. I hope it was really valuable to you. If it was, make sure you give us that thumbs button so that also other people can come across it. And if it was your first time coming across our channel, we do produce such content every week. Make sure you do click that subscribe button and turn on the notification bell so that you don't miss the upcoming videos. Have a great day.